The Institute of Risk Management, the IRM, is an international body that seeks to put some kind of standardisation into the risk management process to give us a bit of consistency, to give us a rule book, if you like, almost, to refer to when we're following best practice for risk management. Categorising risks in the first place, the Institute of Risk Management would say, first of all, make sure that we identify all the risks and considers the relationship between them. As we said earlier on, for example, IT operational risks have a strong connection with reputational risks and longer term strategic risks as well. So it shows what the risks are and how they relate to each other. It also gives you a routine to work through to ensure that you identify hopefully everything. So it's sort of a systematic and step-by-step procedural approach means that you're more likely to identify more risks as a result. The Institute of Risk Management is at pains to point out that some risks are driven by the external environment and they're imposed on the business from the outside. But there are some risks that are more internally driven. They're sourced from inside the organisation. So, for example, you might have financial risks. And if you trade overseas, then you'll be at the mercy of the foreign exchange markets. And that's very much a risk that's externally imposed on the business from the outside world. But how we manage ourselves, how we manage our liquidity, for example, is more internally sourced. And you can apply this kind of logic to strategic risks as well. So competition, for example, is an outside influence on us that imposes risk upon us as an organisation. But what we choose to do in terms of things like research and development is more of an internally chosen activity, which means we're exposed to risk, if you like, through our own choice. Let's spend a bit more time now looking through what we mean by strategic risk. We mentioned that briefly earlier on, to do with the big picture, the long term, looking at what the organisation does for the medium to long term and how it navigates its way through that environment. So there are various things that will affect strategic risks in the organisation. It's to do with the state of the outside world in many ways. So it depends on the products that you sell and therefore the markets and industries that you're exposed to. There's the state of the world in terms of economics. So how well different economies are performing will affect things like interest rates, inflation, exchange rates, and we'll be exposed to those things long term as a result of the way in which we're set up and operating. Possibly slightly more smaller picture than that, we have our industry and our competitors and how they behave, not only in terms of how they price their products and what their products actually are, but maybe more also in terms of corporate activity, buying and selling each other, and so on. There's the stages that we're at in relation to the product's life cycle. So if we have an introduction stage product, for example, then the strategic risks associated with a brand new product centre more around whether or not the idea is likely to be acceptable to our customers. Whether is it going to take off as a product at all? Whereas when we get towards the end of the growth phase, for example, and we're going into maturity, the risk there, because it's a proven idea now, the risk there is more that competitive activity undermines what we're trying to do and it cuts prices and we lose market share, that kind of an idea. So the stage in the product life cycle is a key driver as well. In terms of how we are set up, the research and development that we undertake as an organisation can affect our strategic risk. Research and development tends to be relatively speculative in nature, but it gives us a long-term position within an industry. Some industries, high-tech industries, for example, or pharmaceuticals would be another example, absolutely thrive on the success or otherwise of their research and development, or other types of new technology potentially. Now, reputation and ethics, I think we mentioned earlier on as being an operational an operational concern, which it could be. It depends what aspect of reputation you're looking at. Increasingly, I would argue that actually reputation is more of a long-term positioning issue as far as businesses are concerned. We live in a very competitive world. I think it's fair to say, would you agree? And in that very competitive world, people can switch from one supplier to another quite easily. They can find out who those suppliers are by looking them up on the internet. And it takes very, very little for someone to decide to switch from one to another. Price will always be an important factor, but increasingly things like reputation and whether or not you've been behaving yourself ethically as a business is increasingly important, because if you're named and shamed as someone who has poor ethics as an organisation, then lots of consumers would think, well, why not buy from somewhere else? It's fairly easy to do. And as someone once said, a reputation can take 30 years to build and it can take 30 seconds to destroy. So managing your reputation as an organisation, considering the commercial implications there are from losing your reputation, is absolutely vital. Risks come from information systems as well, and the fact that businesses increasingly rely on information systems, not just for internal operations day to day, but to exist at all. If you think about the revolution that's happened with the internet over the last 20 or 30 years, it's perfectly normal now for businesses to have the internet as the main channel of communication with their suppliers, with their customers, sometimes even with their own employees. So information technology and information systems risks are increasingly important and increasingly seen as strategic in nature, because it affects the way the business operates and affects the success or otherwise of the business model. Financial risks are to do with the way in which organisations are financed. As we mentioned earlier on, the proportion of debt to equity you have, for example, a higher risk business would be one typically with more debt finance. That imposes more risk on the shareholders then, because the company has to pay its interest and capital repayments as and when they fall due. You could also include within financial risks, almost as subsections of them, interest rate risk, which is the possibility that interest rates change, and as a result of that, that affects how our business operates. For example, if we have a lot of debt that's variable rate and interest rates go up, then we'll end up having to pay more interest all of a sudden. Currency risk, particularly if we buy or sell from overseas, then we'll be exposed to currency risk, because the amount of cash that we end up paying or receiving in our domestic currency will be affected by that exchange rate. But even if we don't trade overseas, and this is an interesting concept, even if we don't buy or sell from overseas, we are still exposed to movements in the exchange rates in our country. Because, for example, we could have competitors that try and sell to our customers in our own markets, and the price they charge our customers, or our potential customers, will be affected by exchange rates. So either directly or indirectly, it's very hard to get away from exposure to currency. Market risk is a risk that we gain or lose money because of the availability of certain types of resources. So, for example, we could have an amount of commodity that suddenly becomes in short supply, like oil or gold or something like that. And all of a sudden that pushes the price up of that commodity, which might be something that we really need in our business model. Operational risks are more day-to-day, but as we said earlier on, doesn't mean that they're less important for that. A day-to-day risk can grind the business to a halt instantly. There was a bank recently whose banking app failed, which meant none of their customers could access their funds. It has serious implications and fines, as it turns out, for that bank going forwards, as well as the fact that they've lost customers in droves because of it. So that can include day-to-day sort of business interruptions, computer failures to a degree, non-compliance with regulations and internal procedures, all those kinds of things. Hazards we mentioned earlier on, they could either be natural hazards, so natural disasters, things like earthquakes, volcanoes, flood, fire, you name it, those kinds of things, or diseases. Or they could be human caused, so for example, chemical spills or terrorist attacks. But either way, they are sudden, unexpected, and potentially very serious impact on our business.